Okay, awesome. So thank you all for being here today. I'll give it to Lisa to start presentation.
Sounds good. Hi, everyone. WallStreetBots2 is a continuation of last year's WallStreetBots project. And the goal this year is to predict Bitcoin prices using machine learning. Next slide. Here's the agenda for the presentation. We'll go over the background for the project, how we created the data set, what machine learning models we used, and each of their results, and finish up with some concluding thoughts. So last year's WallStreetBot project predicted the prices of meme stocks like GME using sentiment analysis on Reddit posts. The main limitation we found was that we had a lack of high quality publicly available trading data for stocks. So for this year, next slide, we decided to predict the prices of cryptocurrencies instead, as their prices are determined purely by supply and demand, which should make them more predictable by analyzing public sentiments and market data. So the project structure here is we first obtain market data features and NLP data features separately. Then we train models based on each set of features. And then we try to combine the best models from both streams. Next slide. So we looked at some research regarding the usefulness of sentiment analysis being applied to market, specifically of predicting Bitcoin prices using Twitter sentiment, and also the application of LSTM in market modeling was found to be one of the best models.
So how do we create our data set? So we started off by creating hypotheses for which data should have predictive power in the trading price and why. And then we cross-checked the data against the lagged Bitcoin returns using correlation analysis. So these are all our features. And the only ones I wanted to highlight were the Bitcoin block data and the book and trade data, because they were the only ones that had significant non-zero correlations with the returns. And on the left-hand side here, you can see a snapshot of the order book data. And you can think of the order book data as just a list of trade orders that haven't been executed yet. The left-hand side of the order of the snapshot is how much someone is willing to buy for. You can see that in the green. And on the right-hand side is how much someone is willing to sell for. And this is further divided into levels, where level 1 is the best bid price, and you can see 477 units are available or people have 477 units available to buy at 2,167.75. And on the flip side, there's 290 units of sell orders at 2,168. And where the level 1 prices meet in the middle is the current average selling price. And this data is available on a second-by-second interval. And that's the raw data that we collected. But what's important is that we just use the level 1 and level 2 data. So in this case, it's just the first two. So if you look at the bid prices, only 2,167.75 and 2,167.5. That's how much we went up to. And we also used the trades data, which is an aggregate of the trades that occurred over a second-by-second interval. And this gave us some insights into some statistics like the mean and the median sell price. And as you can see on the right-hand side of the slide, we can derive a lot of features from the order book data that aren't fundamentally there. For example, we engineered the bid and ask spread and the bid and ask strength. The feature engineering process in this situation was mostly a combination of data exploration and using intuition and domain knowledge to figure out what works and what doesn't. Next slide.
So in terms of NLP data, what we did was we didn't have a single data set. So we scraped 100 Twitter per hour per coin. So we're analyzing a few different coins through a range of 3 years. this is a quite big data set that will cost, I think, like $250,000 nowadays to collect if we use the API, what we did with our own scraper. So the one extra thing we did was after we collected the data set, we filtered for bots using some heuristics that we found. Like if you have a lot of following and very few followers and post a lot, you might be like a spam account. So we want to remove that. Once we had this data set, what we wanted was to create a we want to aggregate all the tweets with a sentiment score. And to do that, we use two pre-trained models, so Vader and Google T5, to get scores for positivity, negativity, happiness, sadness, anger, fear, and surprise. So we got this whole spectrum of sentiments. And we also aggregated this in like different time intervals because to test what was best, because sentiments might affect the market in the future. So sometimes 4-hour lags can be better than 1 hour. And also we added like change in each score as a feature, and all the features can be found here. If you want, there's more details about it in our Medium article. I'll pass back to Lisa to talk about the ML models.
Thank you. So yeah, we trained 9 models on different sets of features to predict the log return of Bitcoin at time t+1. The baseline model is the simple moving average model, where the next predicted return is basically the average of the previous n values. This gave directional accuracy of 50.6% and MSE as shown. And we fitted, for all the different models, we fitted ARMA on only historical returns, SVM, XGBoost, and LSTM on sentiment data, and linear regression, LSTM, and hidden Markov model on various market data. The best model for the sentiments data is LSTM with directional accuracy of 56.5, and the best model for market data is also LSTM, fitted on book and trades data with directional accuracy of 67%. Next slide, yeah. We want to further evaluate the best models thoroughly using more than just the directional accuracy. Specifically, we looked at the financial metrics such as the empirical performance of a portfolio trading based on our predicted returns and the Sharpe and Sortino ratio of such a portfolio. And we also looked at statistical metrics like directional accuracy, MSE, confusion matrix, and F1 score.
So when we want to evaluate our model, the answer to that is kind of multidimensional. It's important to understand the successful model from both a scientific lens as well as a financial lens. So first up, we have a 50-second snapshot of the log returns over time in the top left-hand corner. And as you can see, the predicted returns in red hug the actual returns in yellow very closely. And the overall trend of the returns is captured by the model. As well, the mean squared error for the log returns, for the predicted log returns, is on the order of 10 to the -9. So it confirms that we have very low error in our predictions. So next we want to explore what would happen if we created a portfolio and actually executed the trades based on our predictions. If we predicted positive returns, we would long Bitcoin, or we would buy it. And if we predicted negative returns, we would short it or we would sell it. And we assumed that we had no other trading fees or other costs associated with this. And what we got was a return of around 500% over the course of only around 5 minutes. As you can see, the timeline goes up to 3,500 seconds. At the same time, the price of Bitcoin was largely stagnant, and we beat the returns of just holding Bitcoin along the same time period by 47-fold. The blue and yellow lines show the long and short Bitcoin benchmarks. So the short Bitcoin benchmark being that we short Bitcoin for the entire period of time. As well, the Sharpe ratios and Sortino ratios were 0.32 and 0.48. Having close to 1 for the Sharpe ratios is excellent, but anything over 0 is also considered pretty good. And next up, we have the confusion matrix. And for those of us that don't know what a confusion matrix is, imagine a COVID test. A common misconception is that a COVID test only has 2 outcomes, positive and negative, but in reality it has 4. False positive, true positive, false negative, and true negative. A confusion matrix just puts these statistics into a square format to make it easy to read. And in this case, the matrix is also heat mapped, color coded based on the number. As you can see, the true positive and true negative predictions take up the majority of the data. They're around 1,000 data points each. And they both occur in largely the same frequency. So there's no positive or negative bias. So this is an indication that our model is unbiased and accurate in its predictions. And we also calculated the F1 score, which turned out to be 0.625, which confirms this. So overall, we have a raw directional accuracy of 67%. And the histogram down in the bottom middle here shows that the density of wrong predictions along the log returns kind of reaches its peak when the log returns are around 0. And this is because when the price doesn't change much, it's difficult for the model to differentiate actual movement from just noise. So that leads to reduced model efficacy. And then finally, we have a scatter plot of real versus predicted returns. Ideally, we would want both of them to be the exact same, following a linear y equals x trend. But obviously that's impossible, but we can come close. And as you can see, the data follows that trend quite well. So the real and predicted returns are quite similar. And I'll leave it to Fernando to talk about the NLP side of things.
Oops, so I was muted. So thank you, Sujit. So we have here the same graphs, however, for the NLP data. So here we only use the features that we collect from Twitter, as we talked a little bit before. I won't go into detail for every graph just because Sujit did a wonderful job on explaining all of them. But I want to highlight a few differences. So first thing is, as you can see, the quality in general of these results is a little bit lower compared to the market data ones, because we're not using any information about how Bitcoin is like varying. We're only using sentiment for the market. So sometimes, for instance, we have in the bottom center plot, like a log return that is actually very negative and we predicted wrong. However, that said, we still have a quite good portfolio return, as we can see in the middle, like the center figure of the top row. We outperform shorting and holding Bitcoin by significantly, like 6 times. That's quite good. And we still have a directional accuracy of like 56%. There's also one extra advantage that is worth noting about using the NLP data is we don't trade that often. So we're trading every hour instead of like every second. And the advantage is we reduce a lot of the trading costs that are that are part of the limitation of this project. So trading costs are very reduced for this when compared to market data returns. The Sharpe ratio for this model is also like around 0.15, which is not great, but is also not that bad. Now let's discuss a little bit more what are the next steps and limitations of this project. So a few project limitations. One is that like analyzing real-time data and doing, especially for high frequency trading, is very hard and it's still not implemented. So it would be a big step if we wanted to continue implementing the strategies in the real world. Also, as I mentioned, trading costs are very significant, especially if you're trading at high frequency. And it's something that we see in our models, like 47 times returns, which is crazy. But if you consider trading costs, these returns are reduced by a lot. We cannot include that in our model because your trading costs will vary depending on which side of the trading you are doing. So if you're doing as us, it will cost something. If a bank is doing, it will cost way less. So another limitation that we want to discuss is scraping data in real time is hard. It takes time. And now Elon Musk is implementing some changes that make it even harder. And the API prices nowadays are crazy high. And as I mentioned before, if we wanted to collect the data that we have, like using the API, it will cost $250,000, which is not in the budget for UTMIST, I think. So as some next steps of the project, we want to like merge, as we said, the two models that we have. They both have quite good results. So we believe that if we find a way of merging them, which is a challenge because they have different frequencies, so one is second by second, the other was like hour by hour, or even like 4 hours by 4 hours, merging them is hard. But if we can do, we believe that we can achieve an even better model that might get the best of both. It's also, as I said, hard to analyze the different frequencies. And finally, one next step they want to do is understanding the relationships between features to actually get insights about the like about how different features influence the model. Right now, we get very good models, but we still cannot explain which features are causing our results to be great. And that's something that we want to explore in the future. I think that concludes our presentation. Thank you so much for listening, and we're open for any questions you have.
I think there are some questions in the chat, so I'll start off by answering some of them. So one concern is trading cost and the frequency at which we're trading. So yes, right now, like the reported charts and everything, the results is based on very high frequency trading. And yes, this would give pretty high trading costs, and we haven't accounted for those in there, and which is why we list it as a limitation. So it's more unlikely for retail traders to implement this strategy, and more likely for research purposes and for high frequency trading firms like market makers, hedge funds, who have lowered trading costs just inherently because of their business. So it might be more applicable in that sense. But also, if we want, say, to trade it retail wise, what we can do is increase this cutoff for when we make a trade. So in other words, if we predict the return to be high, but like higher above a cutoff, or low but lower than a cutoff, then we make a trade. In that case, we are more with the same level of confidence, but we are predicting a higher, like a greater absolute return. That way we can capture more return with less risk. And we actually did run some simulations using that. So if we use a cutoff of just like a little bit above 0, we were able to get a Sharpe ratio, or actually let's use Sortino, because Sortino only penalizes downside risk, and that got us around 2.8 for Sortino ratio, which is a really good value. And you can see that, like, if we play with the cutoff, you're able to lower the trading frequency, so only trade when you predict high, really large movements.
I think I want to answer another question by, I think, Tiona. It's in the chat, like, can we apply this for the stock market? I would say that was the idea of last year's project. So if you take a look at what WallStreetBots did last year, we were trying to predict the stock market using Reddit data and also market data. As we mentioned at the beginning of the presentation, so I can go back here, there are some limitations of that, mostly with how much data we can get, credible and publicly available data. So that makes it a challenge. But I think overall our strategy, there's nothing in our strategy that's too specific for cryptocurrencies. So analyzing sentiments and using powerful machine learning models is something you can definitely do for the stock market. It's just you need the right data, and that's not always as easy to get as for crypto.
And also for the last question, whether or not we tried to use embeddings and directly pass into MLP. So I guess for embedding, if you're referring to the sentiment embeddings or market data embeddings, well, either way, it's a possibility, and we did try that last year, but with that, it's reduced explainability, and we want to focus on more like feature driven, as in all the features that we selected, inherently there's a reason for, or intuition based on market intuition for why it should work. And we also did a correlation analysis and found all the features that we used to be highly correlated. So I think that inherently would be able to give us higher accuracies.
Well, I think Steven said there is no more time for questions. Again, we appreciate the time and the attention for everyone. Great questions. And thank you so much, Steven, for UTMIST, for giving us the space to talk about our project here. Yeah, have a great day.